Good morning and welcome to all of our clients in Cleveland, Harrisburg, and Chicago. Today's investment town hall is the third in 2022. I'm Deborah Feldman, Managing Director and Wealth Manager of the Fairport Wealth Leonetti team out of Chicago, where we're enjoying a break from the hot, humid 100+ degree days. Today the weather's beautiful. The goal of the investment town hall is to connect you directly with our Chief Investment Officer, John Silvas. He'll recap where we've been, describe where we are today, and share his thoughts on what lies ahead. We've asked for your questions in advance, and John and his team have prepared slides addressing them and other frequently asked questions. Based on your feedback, we've scheduled these webinars on a quarterly basis, and Emily Drake and I will take turns moderating. It's important to us that you have a connection with our investment team as well as your advisor. It can be especially comforting during times when the market is volatile, as we've been experiencing in 2022 so far. There are several ways that we can make this happen for you. You can direct us to send out timely Fairport Perspective updates via email. You can subscribe to the Fairport Flash podcast on Apple Podcasts, Stitcher, or Google Play, or simply follow the hashtag Investing with Fairport on LinkedIn for weekly thoughts on the markets and commentary. Before we begin this presentation, I have a few words about housekeeping. Everyone will be muted for this webinar and your cameras are disabled. If you have questions that arise, you can type them into the questions section of your toolbar and we'll answer as many as we can, time permitting. So, without further delay, I'm turning the microphone over to John Silvas. John?
Yeah, thanks, Deb. And I don't know if you drew the short straw on this one. I know you and Emily tend to rotate, but unfortunately, I think where we are in the markets, we've seen a pretty down year this year so far. And I think we're going to talk a lot about inflation, which we talked a little bit offline already, possible recessions and bear markets. So we will, well, there are some silver linings, so we'll get to those as well. But so let's start it off. We had a great slide for this earlier, but our compliance people wouldn't let us use the pictures. But the last time inflation was this high, and we had a reading out this morning. It was 9.1% year over year. That's over the last 12 months for what they call CPI or Consumer Price Index, which is everybody uses for how you measure inflation. So last time we had a reading that high, Michael Jordan was still in college, and I know Deb in Chicago, he's probably a big Jordan. Tom Brady was in preschool. I remember the song Betty Davis Eyes. I'm 52 years old, but that was a song and was #1 on TV. So I'm not sure if JR was shot yet or not at that point, but it was still #1 on TV. But the one that caught my attention was Diet Coke was not even in the supermarket shelves yet, which I thought Diet Coke's been around forever. So it shows how long it's been. And I hate to say this, but I had one of these myself. Sony Walkman was considered the cutting edge. Now, I don't think my kids, who are all 18, 20, and 23 would even know what a Sony Walkman is. But anyway, that's kind of where we're at today. So I thought that would be good to kind of put it in perspective a little bit for everybody. One other thing, and I think everybody understands it, when it comes to their pocketbooks here, but if you had a 4th of July cookout, I hope everybody had a great 4th of July, I guess last week or a little over a week ago. The cost for the average cookout went up 17%. So inflation is definitely taking hold out there. It's something we'll talk about a little bit this year. We'll talk about more today. And, I think it'll be one of the themes we'll be talking about really for the rest of the year. So I'll pause it for 1 second, Deb. I don't know if you want to ask any lead-off questions, if we'll kind of jump right into the
No, you know what? I think I'll wait until after you talk. We do have questions, though.
Okay, so my apologies, it's actually second quarter review, but I will get into it. So really, no way to sugarcoat this. It's been probably one of the worst. It has been one of the worst starts in the last about 50 years for equity markets. As you can see there on the third column from the right, really the only thing that worked well in the first half of the year was commodities. We'll talk a little bit about that. They've actually come down quite a bit since called middle of the second quarter, but still have held a positive return. Cash has done pretty well. I mean, it's not been going down, but as you go down that list, large cap equities of the S&P 500 is down about 20%. The ACWI, which is the All Country World Index, is a global benchmark that we tend to use for our clients, was down about the same 19.8%. And in bonds, which tend to be the stabilizer or the ballast to portfolios when we see volatility in the equity markets, was actually down about a little over 10% for the first half of the year. So not much has changed since the last few weeks. We're technically almost halfway through the month here, but the S&P was holding on to slight gains, as well as the equity and bonds have been kind of flat for the quarter so far. I know the markets are off to a slow start today, so that's been neutralized a little bit. But again, we'll talk a little bit more about where we think things are going and what we think in the short term, and then maybe a little bit longer as well. One of the reasons, we talked about this in the last quarterly review, and I've had a lot of conversations with clients over the last few months, and I think really what has driven the volatility or the correction in the market's really been, one, the Fed policy, and that's in full force. Everybody's been hearing about the Fed. They raised rates 75 basis points at the last meeting. They have a meeting later this month. It's likely they're going to raise it again. We'll talk about the Fed funds rate a little bit later. And then inflation. And as we kind of kicked off this call, Deb and I were talking about it earlier today. The CPI number came out today. Inflation still is not, well, hopefully it's in the peaking process, but as of the month of June, still seems to be going higher, not lower. So there's kind of things, but it's been driving volatility. And as you can see on this chart in front of you, about 90% of the trading days, this goes through the end of June, have been around 1%. Now that could be up or down 1%, more down than up, unfortunately, this year. But that just kind of shows you how volatile that is. If you look at the chart, the bigger picture, the last time we've seen ranges that high was back in 08, 09 during the financial crisis. So we've definitely seen some volatility out there. Bond market volatility actually has been higher than stock market volatility, and that's a rarity as well. So, but I think if there's one thing in our favor, at least in the short term, there's been a lot of negative sentiment out there, and it remains pretty extreme. And history would suggest, and this is not something that could be longer term, but history would suggest that you should see a bounce as you start to see these very negative readings. In fact, if you can see from the lower right there, we finished the month of June. This is a reading that comes out of the University of Michigan on sentiment was 50. The reading was a 50. The last time we've seen it that low was again back in 08. The average is about 85, as you see that blue dotted line. But usually when you see sentiment extremes that low, you tend to get a bounce off of that. So the point is, people are extremely bearish, or investors are extremely bearish. And usually when you get everybody kind of one side of the boat, it tends to go back the other way, at least in the shorter term. And if you look at that box in the upper left there, the last 8 times, the average is about 24%. So again, at least in the short term, it looks like we're kind of due for a bounce. That has not happened as of yet, but something. So, the opposite of what happened back in 2020 off the market lows is we saw the market do pretty well, and it was mostly driven by multiple growth or multiple expansion. So price to earnings ratio would go up, what you're willing to pay for a dollar's worth of earnings, so to speak. That has actually come down. So we started the year, and we'll talk about on a slide later on multiples, but we around 21 times. We're down about 16 times, give or take. We're actually below that. So most of the decline so far this year has been on multiple contraction. I know it says multiple growth there for the blue line, but really there hasn't been multiple growth. It's been multiple contraction. Earnings, on the other hand, have held up fairly well. That's that gray line in the upper part of the chart. And so far, they've grown about 10% year over year. In the first quarter, we're literally just kicking off second quarter earnings. JP Morgan, which is kind of the unofficial kickoff, will report tomorrow. There's been a few companies out there, but so far earnings, at least for the second quarter, have been good. I think where we're going to start having more discussions going forward is the guidance going into the second half of the year. We'll talk about that as well. I'll pause there real quick. I don't know if you have any questions or if there's any questions submitted.
Well, since you were talking about performance of different asset classes, what's working as an investment in this market and why?
Yeah, so I have a chart out there that shows you, and I'll get to it as we get into the market commentary part of it. But really, it's been the more defensive nature of the market. Consumer staples. The biggest one has been energy, and that was more first in beginning of the second quarter that energy or oil prices got up to about, I think, 130 back in March. They've come down a little bit. They've actually come down quite a bit recently. So I don't know if that'll be a second half story or not, but at least in the first half of the year, the energy side and anything on the defensive side are commodities based. A lot of the ag commodities did really well in the first half. Again, not sure that's going to be a second half story as we start to see a little bit of a turn there. Flip side of that, if that's the other question, what hasn't worked has really been more the growth of the end of the spectrum or the cyclical stuff, the consumer discretionaries, technology, and I'll get into some of those things as well as we get into the middle part of the presentation. So
we have a lot of interest in the Ukraine war. And one of the questions is the PE ratios of small and mid cap stocks as groups are well below large caps. Would these be a better value than large caps at this time? And if so, should we consider adding to those subclasses?
Yeah, so I always think there's kind of two parts to that question, or two reasons on that. One is multiples, and I think you stated that correctly. Small and mid cap multiples, price to earnings ratios have come down, and I would say they're in that range where, well, a lot of things are in the range where valuations look attractive or cheap, even more so than large cap equities. I think the second question you have to ask, what is the catalyst for those to outperform going forward? And I think that's a tougher question to answer. I think the valuations are definitely there. Catalysts seem to be a little tougher. Small cap stocks tend to do pretty well as the economy tends to bottom and start to go back up. So if you go back to 2020, which is probably the most recent example of that, we saw small caps underperform in that 5-week downturn we had that bottomed in March of 2020. And then as we came out of that and the economy started to improve, probably a month or two later, they tend to lead coming out of that. So we actually added the two small mid caps at that point, had a pretty good run up through called middle of 2020. They kind of lead for about a year on the market bottoms, which pretty much textbook they did. And then they've underperformed, still relatively positive in 2021, but underperformed relative to large caps. So I think to answer your question, what is the catalyst going out there? I think as we get closer and we get a better sign that the economy's bottom, and we'll talk a little bit about that, I would think that they will lead in that recovery. So it might be a little early to be adding to those small cap positions. We actually trimmed them late last year and earlier this year. But to your point, I think they do look attractive from a timing standpoint. I'd probably rather stay in the safe large cap names, and we tend to be a little more appropriate large caps. But I think, go ahead.
What impact will the war and inflation have on items that you look at regarding cash held in the account?
So you got to state that again, as far as cash goes?
Yeah, with the war and inflation, and what other items do you look at when managing the account? I think that's what they mean. And how will that affect the amount of cash held in the account? Would you, for example, sell securities and hold cash, more cash at this time?
Yeah, so I think if we've learned anything over the last, I'll call it 12 months, maybe it's 18 months down the, we had a bottom in late 2020. I think 10-year Treasury got to maybe 25, 30 basis points. I'm not exactly sure what the bottom was, but it was pretty low. And then we've seen rates go all the way up to almost I think they touched 350 in June, if I'm not mistaken. 350 was the high. So if we learned anything over the last 12 months, that cash can be a better asset class times than fixed income. And I think that's been the case for at least the last 12 months, probably really the last 18. So, we've had probably more than our target in cash. So if we had a target of 3, we're probably at 4 or 5. And I think we're okay with that because I think we've seen a pretty tough market in fixed income area, so we've been kind of short in that area. So I think at times you're going to see higher cash values. I don't think we're 30 or 40%. You know, we're not looking at the time to market in that sense, but we could see some elevated targets in cash. I guess the second part, if I understood you right, is you know, we've probably been net sellers of equities over the year, over the last really 18 months, just because earlier from the bounce off the lows in 2020 and then having a pretty good 2021, our equity allocations were kind of on the higher end of the range. So we've been taking some of those profits, and we did that throughout last year, and we did it for the most part at the beginning of this year. Now, I do think we're kind of in that period where, depending where the economy is and where we are heading towards it, if we are in fact heading towards a recession, that, you know, valuations are looking a little more attractive. Just quick to trim those positions back, but I guess in the short term, any slight overweight in cash will probably hold that for the near term. Hopefully, sometime as we get into the second half of this year, we can talk a little bit about that as we go forward. Looks a little more attractive, but I do think, you know, again, cash is a tool to use. It does have a place in the portfolio, and I think with the Fed funds rate moving up, which is the short end of the curve, the returns aren't as bad as they were. I wouldn't say they're great, but they're not as bad as they were. I think you know, get 150 basis points maybe now. I know inflation's much higher than that, but again, we've moved off that where you get 1 or 2 basis points. So, and that should go higher as the Fed funds go higher, which we think they will.
Okay, good. That's all I have for now, John. Thank you.
If I had a definitive bet here, I would have the highest conviction on the Fed funds rate will go higher. That's, you know, that's probably my best call, because I think I wouldn't say it's a no-brainer, but it's pretty darn close. So okay, so move on to the economy. We touched on a couple of these things, but we'll keep going. You know, GDP has kind of stalled out there earlier in the year. I think ourselves, with a lot of people, thought we'd see, you know, at least trend growth, or maybe slightly above trend growth, which is about 2% GDP growth year over year. That's looking less and less likely this year. As you can see, see if I can move my cursor over at that first quarter, GDP was negative 1.6%. We're kind of on watch for a second negative quarter here. The second quarter is already behind us, but we'll get a GDP reading sometime at the end of this month. So we're kind of on watch for that. I think everybody's kind of on the recession watch at this point. I don't think it's likely we're going to see a recession in 2022, but it's fairly close call, and I would say it's getting closer by the day. So we'll see. I think you know, if you look at like the GDP now, which is the Atlanta Fed economic forecast, which we've used before, it's forecasting a slightly negative return in the second quarter. So, but I think there's some areas that the economy is still doing pretty well, and we'll touch on those. So I think it's kind of a close call, but I don't think we're going to see a recession. At least I don't think we're in one. But again, we'll keep a close eye on it. Again, you know, we've talked about company surveys before. Evercore ISI puts this out. I think it's a great real-time indicator of where we're at. It doesn't seem to be pointing to a recession. Its number is 57, so anything above that 50 would be solid growth. We're in that strong to solid growth area at 57. You know, this time could be different, and I think we use that term a lot. You know, we're coming off of a fairly strong shutdown of the economy in 2020. A lot of stimulus came into the system, which is kind of unprecedented. So we're all kind of dealing with that as we go forward. So, you know, sometimes these things may not hold as well as you'd like, but history would tell you usually in that 55 to 60 range is very unlikely to see a recession. And then the other thing is we saw the unemployment, or the employment number last Friday was 372,000 new jobs were created in the month of June. There's still 10 million jobs out there that are open that people that aren't being filled. So it seems like the employment side of things still looks good, but you know, again, I think we're kind of in uncharted territory here. So again, I think there's another area of strength in the economy. Travel seems to be pretty robust. I know most of my friends have either taken vacations. A lot of people are complaining about delays and cancellations on their flights, but from the airline standpoint, they're doing pretty well. In fact, this is the best reading they've had in the airline survey, I think, since 2012. So, 10 years. And so far, the travel industry looks pretty robust out there. So I think there are pockets of strength out there in the economy. Inflation obviously is taking its toll, but I think, again, it's a close call. We think we'll get out of the year without seeing a recession, at least not here currently. So, where does all this lead us with the Fed? As I said earlier, the Fed policy tends to be one of the driving forces for the market volatility out there, and I'm sure we'll see that again as we get into the Fed meeting near the end of the month. So it's our view, and it's a pretty consensus view, that the Fed's going to continue to raise rates into year end. If they're targeting about 350 on their Fed funds rate, right now they're at 175. I wouldn't doubt after today's inflation number that 350 might actually pick up to 375 or maybe a little higher than that as they get into the end of the year. So there's a good chance they're going to raise rates. Again, a very good chance they're going to raise rates 75 basis points this month. They have another meeting in September. That's probably more likely at least 50, but probably gearing towards 75 as well. So if you look at the chart in front of you, this will show you where the Fed funds rate was. That's the blue line versus the inflation rate, which is the reddish pink line. So if you look all the way to the right where it says today, right now we're at 175. Inflation actually ticked up to 9.1 today, so that number is what shows on the chart. And at some point, those two have to cross. And that's kind of where historically the Fed has stopped raising rates. Now, unfortunately, sometimes they raise rates too much, and that kind of slows the economy into recession. We're hoping, as Chairman Powell said, he's trying to orchestrate a soft landing, which will avoid that. History tells you that's hard to do, but not impossible. So, so that's where we're looking at. So that's why I think Fed policy will continue to play a pretty large role here as we move forward. Inflation and Fed policy, as you can see here on this chart, tend to be interwoven, and I think that's something we're keeping a close eye on. But I do think the inflation may start to show signs of peaking, and it's probably been showing signs of peaking in late June, early July, so it doesn't really translate to that 9.1 number that we just heard, but I think we're getting close, and we'll talk a few points on that. So the red box on this chart is the core PCE deflator, which is what the Fed looks at. That's kind of their go-to number. Now, it doesn't hold energy and or food prices, which a lot of people would say is crazy because everybody pays for food, everybody pays for gas. So I get that point, but that's what the Fed tends to look at. And that number tends to look like it's been peaked or peaking. So we're going to keep an eye on that one. I wouldn't take a victory lap yet, but we'll see. But as you can see by the chart here, we're seeing very elevated inflation numbers. I think the hope is that we're close to that peak. And why that's important, I think, as as inflation starts to peak, multiples will start to go back up, and multiples goes back up. Hopefully, with the backdrop of solid earnings, we'll see better returns in the market going forward. So I did say there's a few areas where it looks like things are starting to roll over. This is the AAA. I think everybody knows what AAA is. They do a daily gas survey. As you can see, sometime in late June, it peaked, and it's been coming down. I was, if there's any humor in this, I thought when gas was $4.75 a month ago, everybody was complaining how high it was. And then we got the $5 on average, people were complaining. Now that it's $4.75, people are saying, wow, gas is only $4.75, which is kind of ironic because over the course of a month, you both were upset about it and excited about it. So, but I just looked today, as of yesterday, the average price is $4.63. So we're starting to see it come down. That tends to be one of those things that kind of permeates through things. Transportation costs comes out of the pocketbook for people, tends to hurt more the people in the lower income. So I think you can see gasoline prices come down, which is probably a function of oil prices coming down. That tends to be a good thing. So maybe there's a silver lining out there as we go forward. So I'll pause there before we jump in the markets. I don't know if you have any other questions.
Well, since you're talking a lot about the Fed, how do you think the Fed's hawkish stance on interest rate increases will affect the fixed income strategy in our portfolios?
Yeah, that's a great question. So I touched a little bit on that earlier with the cash question, but so Rick D'Amico, who heads up our fixed income strategy and fixed income investing, we have been short on our duration, and I have a slide in here I'll talk to that about, but the shorter duration tends to help mitigate some of that increase in rates, which it's an inverse relationship. So when rates go up, bond prices come down, which is why you're seeing a decline in the ag, like we talked about earlier, 10%. So we went from 150 to 350 basically from the end of 2021, which is 150 basis points to 350 basis points of 3.5%, and that had a negative effect on bonds. I do think this is a little bit inside baseball, so to speak, but the interest rates on a 10-year Treasury, which the Fed doesn't really control, tend to peak around the same time inflation, or maybe a little before inflation does. So if we're seeing a peak in inflation, we could possibly see some peak in interest rates as far as the 10-year goes. But so far we've been short duration. I think we're going to continue to be short on duration. That's helped us on a relative basis to performance on bonds. So our performance has been a little better. Still negative, but not as bad as the ag. And I don't see us changing that anytime soon. So I think as Fed continues to raise the rates here, we see the long end of the curve with the 10-year kind of hovering at that 3%. I think we'll see our duration stay short of the benchmark. I do think bigger picture, 3% or 3.5% where we've been for the last few weeks. Bonds, the risk reward looks a little more attractive than it did at 1.5% earlier in the year. So we could slightly adjust that duration, but I still think we'll be on the shorter end of the benchmark.
How much effect do you think the strong dollar will have on profits of U.S. companies going forward?
Yeah, so I got another slide on that one. You're getting ahead of my slides, but
Sorry.
No, that's okay. So I think well, most companies in the S&P, although they're considered U.S. companies, have a strong overseas revenue stream. So if you're Coca-Cola, for example, or a Pepsi or IBM or Google for that matter, you tend to have a lot of overseas sales. So when you translate that money back into U.S. dollars, when the dollar or the currency is strong, it tends to be a negative effect on your earnings. And I think you're going to see a headwind there. There's a lot of things that are headwinds on earnings, which is why a lot of people are a little concerned about the guidance going forward. One of them would be the strong dollar, have a negative effect. Most companies can strip that out and report X currency, but at the end of the day, it's going to have an effect on earnings. So, any other questions?
No, I'm afraid to ask anymore until I see what comes next. We're
Fair
good
enough.
to go for now.
Okay. So talked about multiples a little bit, and I won't go on too much longer on this one, but multiples are now below the long-term average. We're at 16 times forward earnings. That's the next 12 months of earnings. We're below that 25-year average. So big picture, as you're looking at this, and you have a 3 to 5 year time horizon, it's hard not to say that the multiples aren't attractive. When we were up in the 18, 19, 20 times, you could argue that multiples were touched. So I think multiples look pretty good right now. That's again a case of higher rates, which is higher inflation. I think the question is, so those it's price to earnings, and earnings, I think people are a little concerned where guys go, and we'll get more clarity over the next couple of weeks. And Debbie hit on one is FX or currency fluctuations is going to be a headwind. And I'll talk a second on some other things. But I think again, if you're looking at this and you have a horizon in the next 3 to 5 years, I think multiples are pretty attractive at this point. So again, if there's a silver lining here, it's that they've come down. They could come down a little further, and that's a possibility. But I think as we're looking out over a longer time horizon, they look like an attractive point. So talking about earnings, I think again, I think the top line of the earnings or the top line of the company's revenue looks pretty solid. And I think that's continued to be a good example. Pepsi just a big company, it's a multinational company. We don't own the stock, but again, came out recently and their revenue was pretty good and they're good. I think where people are concerned are on the cost. So as you can see here, they list off a few things, but costs are about almost 15%. It's higher labor costs, so you're paying higher wages, higher material costs. If you have to put copper or iron ore, or you're buying plastics, oil, whatever that input cost, those tend to be higher. And then, as we talked about gasoline, higher transportation costs. So if you're a Walmart or somebody, and I don't know how many Walmart trucks I pass on the turnpike on any given weekend, the cost of moving that materials is getting higher. So I think it's not so much the top line of the companies that we're worried about the revenue. I think it's more the expenses and then how that affects the earnings going forward. So we'll have a little more clarity going probably in a couple of weeks from now as we go through earnings. I do think you'll start to see some guiding down. I'm not so much worried about the companies guiding the earnings a little lower. If the year-over-year numbers start to become negative, or meaning earnings are falling as a group in the S&P, not individuals, then I think that's a little more of a concern. But I don't want to get the cart before the horse at this point. So I think we'll kind of watch this forward. I think it's points there. But, and then again, if to go back to we've seen a lot of stress on the consumer. As mentioned, sentiment's been very negative. There's the old saying that you want to be greedy when people are fearful, and fearful when people are greedy. I would say people are fearful. If you look at that consumer stress indicator, that combines food, mortgage rates, and gasoline prices, and it's at a high we haven't seen for over 20 years. It tends to be a pretty good indicator that forward returns will be better than average. So if you look at the bottom right there, we're in the top quintile of those readings, and usually a year like that, those top quintiles are up 17% on average. I'm not saying that we'll see 17%, but I think we're in that period where you want to be a little more greedy here when people are fearful, and I think we're kind of at that spot. And again, I think all is lost here. And the other thing I think from a market standpoint or company standpoint is, dividends keep going up, and they've gone up fairly steady here, coming off the bottom in 2020. They came up again in the first quarter. There's been some companies that already announced dividend increases going into the second quarter or going in the second half. And there's a old saying that earnings are an opinion, but dividends are a fact. So it's hard to mask any accounting issues on dividends. If you're paying out money to everybody and it's going up every quarter, that's a pretty good indication that balance sheets are pretty strong. And companies with a high conviction that they're willing to pay out, because no one really wants to increase a dividend on the first quarter and then 2 quarters later decrease their dividend. That looks like a sign of weakness. So usually when they make those increases, it's because they think there's a long-term strength to the company. So again, I think that's been a positive out there, and I think dividends will play a bigger role as we go forward here. So really, as far as the markets go, we talked about inflation, we talked about recession, earnings, any type of guidance going forward. I think really, if it boils down to one thing, it's where we are within the economic cycle. So if we're close to a bear market, if we're close to a recession, and that remains to be seen. I mean, again, the inflation is very high, but as I mentioned, employment, other areas look pretty good still. I think if we're in a recession or very close to recession, as you can see in that column in the middle, bear markets during a recession, you see about about a 33% decline in the last, call them up a year and a half. If you're in a non-recessionary bear market, which are rare but do happen, you go down about 23%. We were down about 24, so we're in that range, and it lasts about 7 months, and we're probably 6 months into our bear market now. So, if it looks more and more likely that we're not going to see a recession, then I think we're probably in the late innings. I'll call it the 7th, 8th, 9th inning of the ball game. If we're in that recessionary area, and that remains to be seen, then we're probably in the 5th or 6th inning, 7th inning. I'm a bad baseball analogy person, but my point is, I think right now we're leaning towards that non-recessionary bear environment. Conviction's not as high as I'd like it to be, but I think that's kind of where we're at today. And the markets have not retested that low back in I guess it was early June. We very well may, but so far we haven't. And until proven otherwise, we're kind of in the bottoming process. So, I think if you look at it, I think there's a silver lining there. So, looks like you're going to ask a question, Deb. Are you going to ask a question?
Okay, since we're talking about recession, and I know clients are really interested in our opinion on that, what would the investment strategy be for the next 6 months with all this uncertainty? What are your plans for the portfolios?
Yeah, so I think, as I mentioned before, we probably raised a little more cash than we normally hold. I don't think that'll change anytime soon. We've shifted our portfolios to more defensive nature, so and I'll touch on that in a second when we get into the portfolios. We used to have a cyclically based portfolio of individual equities, and now we definitely have moved more towards a defensive posturing. So I think that's one thing. I don't know if that'll change anytime soon. We've shortened up our duration because, again, we think we're going to see higher duration, or I'm sorry, higher interest rates out there. So we've done that as well. So I think we've done a couple of things. Again, I'm not making a recession call here because I think the data is just it's too close to call at this point. But assuming we do go into recession, or we are in a recession, I think we had this question a lot in 2020. Why the market going up if the economy is so bad? I think we've had that question a lot during that time frame. The markets tend to bottom early in a recession, and then they tend to bounce before the recession is over. About 4 months into a recession, it tends to bounce, and the recession, continue to go on. So you get that environment where the economy looks horrible, and the markets are going higher, and everybody can't figure out. I think just the markets tend to be a leading indicator of the economy, and that's how they work. So if we have been built a little more defensive, I think we'll probably stay that. You mentioned this next 6 months. I don't know the time frame exactly, but probably between now and as we get to the end of the year. If it does look like things have, the dust has started to settle, we probably look to be a little more aggressive going forward. But I don't think we're there yet, and we may not be there for a few months. I'll talk about this at the end, but there's strong data out there that suggests, as we get closer to the midterm election, which is November, so we're still called 4 months, give or take, away from, markets tend to act fairly positively. I can get into reasons why, but it tends to be a good environment. So I think we have a period between now and that in November where we're going to figure out a lot of these things. I hope they break for us. Hope's not a great strategy, so we're not just putting our eggs in the hope basket. I do think we tend to move a little more defensively, and I think we'll probably stay there for at least for the next quarter or so.
Okay, thank you.
Yeah, no problem. So we've already touched on this a lot, so I won't get into it. But historically, we've seen pretty poor start to fixed income returns in 2022. As you can see, that black line down here, if I can get my cursor there, 2022 has been trending as one of the worst years in fixed income, down 10.3 for the first 6 months of the year, the first half of the year. We went from a 151 Fed fund, 10-year Treasury at the end of 2021, it was 1.5%, got up to 3.5%. From a percentage standpoint, that's a huge move. And they've come off a little bit since then, but really, most of it came from the intermediate to long-term bonds. As I mentioned earlier, our duration's been a little shorter than that, than the average, so we've tried to avoid some of that decline, and I think that's helped us on a relative basis. And again, the ag is about 6.5 on duration, which is that, it says the Bloomberg Ag Index top there, which is kind of what the benchmark is, and we're well below that 6.5. So, we can talk a little bit about where you're going over the next couple of months. Staying in that area as far as fixed income as well. And then, I always put this in there because I always find these things interesting. When no one expects something to happen, that usually tends to be when it does happen. This is a chart from Strategas, and they go out and look at, I think it's about 50 people they survey on the sell side, and they ask them where they think the 10-year Treasury will be in the fourth quarter, and no one out of the 50 thinks it's going to be higher than 4%. I'm not advocating or predicting a 4% yield on the 10-year, but usually when no one out of 50 people say it's going to happen, it tends to give me a little bit of pause. So we'll see how that works out. But right now we're in that middle column of we're just a little bit over 3% right now today. Which way we break remains to be seen. So, and again, just kind of an update. We talked a lot about this back in 2020. There was $17 billion in global debt that had a negative yield. And as we've seen interest rates rise globally, not just here in the U.S., that's pretty much abated. There's probably less than, if I could read the chart right, probably less than $3 billion that is has negative yield. So, rates have not only gone up in the United States, they've gone up in Germany, Japan, Europe. So we're seeing that all across the world. So I'll pause there. Any other questions, Deb?
Not at this moment.
All right. So, we talked a little bit about this already because I know Deb asked a question about what we're doing. So we've shifted from a cyclical to a more defensive bias as the economy has slowed in here, and I mentioned a little bit. So you can see if you looked at the beginning of the year, information technology and consumer discretionary, one of our bigger holdings. Now that we're both underweight both those holdings. Consumer staples, which is in the top half there, it's about 85 basis points overweight. Healthcare, about 3 basis points. We're overweight both those, which we were underweight earlier in the year. So we kind of shifted our focus. Got a little flat-footed in the first quarter because growth and technology did come under pressure more in the first quarter than most, as we rotated from a growth doing well to value doing well, or I would call more cyclical to defensive. We've seen that as well. Feel pretty good about where we're at today. I think if you're looking forward, we probably could see us add a little bit more to healthcare. Healthcare tends to be one of the best performing sectors when the inflation does peak, and I think we're pretty close to that. So you want to start positioning yourself for that in the future, and same with staples. So those are two areas we've added to. I think we'll continue to add. We are overweight energy. I think that's been beneficial for us, but I think that trade's coming to an end, which goes back to your question earlier, which I joked that you kind of got a look at me. What's done well, what hasn't? So far, energy's been the lead in the first half. Technology's trailed the index in the first half, and as you can see here on the chart, all the way to the left there, oil. If you owned oil, or you had a bit, you're swinging for oil, that'd have been great. The energy did pretty well in the first half of the year. That's kind of unwound a little bit in the last few weeks. We'll see if that has further to go. And then the far information technology, as it's pointed out there in the blue, hopefully not a lot of our clients, but if any Bitcoin, that's not done pretty well. It's done pretty poorly, I should say. Consumer discretionary is that column second right. So I think there's definitely been a rotation, and I think that's probably going to hold into the second half of the year. That's kind of how we positioned ourselves. We could see some rallies in there, and that there might be some counter rallies, but I think as we go forward, I think more defensive areas do better. And then A lot of questions on domestic equities versus international. Again, domestic have continued to outperform. You asked about the dollar. The dollar could be one of those things that maybe help um, change that trend as the dollar continues to break out. And I think the euro just went to parity, which means that $1 equals €1, which hasn't happened, I think, in 20 years. So that could be a catalyst as we go into the second half of the year. But we remain overweight domestic equities relative to our market, which is the average. So. And again, a lot has changed over the last 6 to 12 months. It used to be where dividend yields were greater than the 10-year Treasury, and I think every company, 80% of the companies were doing better, are yielding higher than the 10-year Treasury. That's down to about 10%, which is just how much yields have moved recently. So dividends are no longer the best yield in town out there as far as the markets go. I do think that will be a bigger focus on dividends going forward. Again, that tends to be a better indication of balance sheets, and I think as we go forward, our yield portfolio was probably 25 basis points below the S&P, and we're pretty much parity with them now. So again, we've added some portfolio that we have better yields going forward. So I'll pause there. Got a couple of things talk about going forward. I think we hit a lot of them, but we'll talk about them anyway. Any questions?
Yeah, this one's from Cleveland. Given that the war in Ukraine is a primary cause for current global food insecurity and energy shortages, do you believe that the market can significantly recover prior to the end of this conflict? And if so, how?
Yeah, so geopolitics isn't really my strong point. So what stops or ends the war in Ukraine is a tough one. So I won't try to put a time frame to that, but it's definitely played wreaked havoc on the energy markets for sure. So oil, natural gas, I think that's probably going to get worse before it gets better. As we get into the winter months, I'm sure that the natural gas shortages or threat of cutting off natural gas to Europe is going to be a bigger and bigger story. So I think it does have an overarching effect on equity markets, mainly because of the commodity, the oil commodity, the natural gas commodity. You're starting to hear that same thing with food, and again, I don't know Ukrainian exports that well, but because I know one of the bigger exporters of grains, that's been a concern. There's concern about food shortages and those things. So not sure how it's going to play out. I don't think it's the only thing driving the market declines recently, but I think it's probably one of them. But if you look at the commodity prices, which to me is from a market standpoint, it's easier to look at than the geopolitics of it all. Agriculture commodities have come down fairly steeply, and so have oil prices. So from that standpoint, that's got a better effect going forward on markets, especially on the input cost. On the food scarcity one, that's a tough one. I won't wade into that answer, but I think on commodity prices, but so far it seems to be they're coming down. Probably more because they're trying to price in a global slowdown on the economy than the actual conflict. But again, they're starting to they have come down. I think they'll continue to come down in the short term. But I think as long as Russia has a large hold on oil production, and they have some part they're willing to kind of go along with them, I think it's going to have some overlapping effect of the equity market going forward. Sure.
Thank you.
Yeah. So again, if history is a guide, we could see a bounce as we move forward here. If you look at, unfortunately, you got to look at the 5 worst starts to the first half of the year. We're kind of right in the middle there for 2022. Second half tends to be pretty positive. Not something I would put all my eggs in one basket on, but on average, it's about 24% bounce. So I do think, from a sentiment standpoint, we're kind of overdue from that stress indicator that I mentioned. We're kind of close to an overdue. I don't know if I don't know if that's a trend change or just a bounce in the current trend we're in, but we should see some relief here, hopefully going into the second half, and hopefully we'll get more clarity on inflation and those other things as well. Mentioned midterm elections, so we are in what they call the second year. If you can see here, the second year of a presidential cycle. There's 4 years in the presidential cycle. Obviously, the election year would be the fourth year. First year of the president, which was 2021, and then 2022 would be the second year as we go forward. You can see, I move my arrow a little bit, but the bottom tends to be in that right before the midterm elections, and then history would tell you, if you go back to this 4-year cycle, and it's held pretty well over the years. The bottom in the the fourth quarter of the second year, which is coincides with the bottom of the markets and/or the midterm elections, and then the first 3 months into the third year tend to be the best period of markets. And this goes back several years. So we're kind of leaving the worst period in the 4-year cycle and starting to enter the best year in the 4-year cycle. So we'll see how that plays. But again, if you're looking for silver linings, I think it's been a pretty good pattern. It's held pretty well, back to 1900, as you can see in the chart there. And we're going to be entering that best 4-year period, or 4-quarter period, sorry, probably in the next couple months. So we'll keep a close eye on that as well. But midterms do tend to be a referendum on the president. That's just the way it is, regardless of what party the president is. And President Biden, fortunately, unfortunately, depending on how you look at it, I suppose, has an approval rating of about 38% as far as real clear politics go. That's not a good spot to be in as you go into midterm elections. And most likely, if it was held today, you'd see the House probably switch sides to the Republicans. Senate would be a little closer call, but I think the polling indicates that they would have a small majority in the Senate as well, which would, again, go into more of a gridlock. We haven't really seen much happen out of Washington to begin with, but it would be more the same probably going forward. So I think as far as fiscal policy goes, we wouldn't see a lot of big spending bills and those type of things. So I think net probably a good thing for markets, but we'll see how that plays out. But a lot can change between here and November, so we'll see. And then finally, as I mentioned, I think to me the big thing is the recession watch out there. This is from BlackRock. They put 5 things together that they look at as far as where they're at today and the current levels of concern they would be. That yellow numbers to the right. We haven't really got there yet. Unemployment rate's still pretty low. Lending standards, still pretty good. Production's good. So people are still spending, as I mentioned, on airlines and things. So far they haven't seen it, but again, I think those numbers are close, and that's something we're going to keep a close eye on going forward. But I guess in parting, we talk a lot about recessions. We talk a lot about inflation, Fed policy, earnings being guided lower. But I do think we're probably, from my standpoint, watching the recession indicator the closest. And I still think that so far hasn't forecasted a recession yet. We haven't seen one yet, but it's a close call. But I think as we look out over the next, and I always like to say I focus on the next 3 years, not the next 3 weeks. If you're looking at the next 3 years, I think from a valuation standpoint, from health of the balance sheets overall, I think things look a little more attractive than they did earlier in the year. And I think we're going to get to that point sometime in the middle of this year, or the middle of the second half here, as we go into the midterms, where I think we're going to start to see some green shoots come out. And call me an optimist if it's fine. I think we'll start to see some green shoots, and some of these numbers, like inflation, will start to come down behind us, not ahead of us. So I'm still fairly optimistic from that standpoint on a longer-term basis. Yeah, I know we've asked questions along the way, so I don't know if there's any more out there, but if anybody wants to ask a question.
I think we're good for today, Jen. Thank you.
All right. Thank you very much. Thanks, Deb. I appreciate you doing this with us. Annika and marketing, and everybody else that helps put time and effort into this. It's definitely a team effort, so I appreciate everybody's help.
Nicely done. If we were unable to get to your question today, the investment team and or your advisor will reach out to you directly. We want to thank you for joining us today. It's our privilege to inspire you and your family. And we feel sincere gratitude for your trust and loyalty. Stay safe and well until next time. Bye.